So everybody has had their eyes on interest rates. It really seems to be dictating the market real estate wise. And rates can fluctuate every day for reasons like inflation or where the Fed rate is, all kinds of different reasons. So the smartest thing you can do is consult a professional mortgage lender. And wouldn't you know it, I happen to have one right here. This is Josh Heape with Canopy Mortgage. He and I are partners. We've worked together for a lot of years. So tell us a little bit about mortgage rates. I know we dipped into the fives for like a hot minute, right?
We did.
And now we're back to the mid sixes.
Yep. So we dipped in the fives, I guess, a couple of weeks ago.
Right.
Now we're back right around 6.6. The Fed is kind of in a fight with the market. The market doesn't think the rates need to go any higher. The Fed disagrees. They don't think they have inflation quite under control, so the Fed's still sticking to the original plan of small increments of, I think they did a quarter last time. They're expecting another quarter coming up.
Do you think we'll ever see the threes again? Or the twos?
I think we will, but it won't be for several years.
You do think we will?
I think we will.
Okay, because a few people have said, oh, we'll never see that again in our lifetime, that they'll go that low.
Yeah. I think we'll probably see some sort of economic crash at some point down the road, and the Fed will have to step back in just like they did now and do the same thing again.
So typically during a crash, though, we call that a recession.
Correct.
And we usually see interest rates go down during recessions, historically.
Yep.
But then I think the problem is, not really for lending, but on, the real estate end of it, then people are concerned we're in a recession and they still are a little hesitant to buy, even though rates are low.
Yeah. But most of the indicators are showing that we're not truly in a recession. We have some low consumer confidence. We have consumers out there that are definitely holding on to money.
Right.
But we have strong jobs right now.
Right.
Housing market is not really dipped.
Right.
So
yeah,
we're still...
It's corrected. We needed it to do that, though.
We did.
Because it was out of control. So we needed a correction. So we don't have any indicators showing that, the real estate market is going to just hit the skids. I think we're probably right now as low as we're going to go, because we're starting to see things turn around. Just this last weekend, I had properties that, had been sitting with no showings. Nearly every single one of my listings got showings.
Yep.
It's like, okay, I can feel it. It's coming back.
I felt the same in my end. There's more buyers now that have finally stepped back into the realm and said, I want to get pre-qualified. We're out looking.
So for those people, Josh, what options do they have as far as, a lot of people don't understand, and we have to explain it to them, like what a rate buy down is. Can you, like in the most basic terms, explain what that is?
Sure. Let's talk about, let's say the current rate today is 6.6. Mm-hmm. We have a program called the 2-1 buy down. Think of the 2 as you subtract that from the current mortgage rate right now.
Okay.
And that's going to be your first year.
Okay.
That 1 is going to be the next year, and it's going to be 1% below what your current rate is.
So the first year would be 4.6.
Yep.
And then the second year would be 5.6. And then it goes back to the rate in which
you locked. I think the misnomer is people think, do I now have to lock it 3 years from now at the current rates? You don't. You lock it today.
Right.
And so you get 6.6, but you actually get 4.6 year 1,
Okay.
5.6 year 2, and then you're locked in at 6.6.
Just 6.6. And so if interest rates go up, you're in a good spot.
You're
if they go
fine.
down, you can refinance.
Correct.
And get down to
And our
a lower
overall
rate.
hopes and thoughts are we're going to see some sort of a dip in rates inside of 2 years. So if they can take their 6.6 and maybe lock it in at 5.6 or 4.6 and not have to worry about it again for there on out.
Right. So that has to be seller paid, though. Explain that.
Yeah, correct. It costs about 2 points to buy down that 2-1 buy down. It does have to come from the seller. So if you do simple math, if it's a $200,000 loan, it's about a $4,000 cost to the seller. But in this market, as you've probably seen, that's where sellers are willing to do that in this market.
Right. Sellers are back to, allowing concessions. And that's what we've been doing for nearly all of our buyers, is asking for a rate buy down. So you ask for about, like you said, 2% or so in concessions.
Yeah.
And
I'm seeing a lot more than that. I'm seeing sometimes 3 and 4. So the buyers are getting their buy down paid for, and then most of their closing costs paid for.
And then their closing costs.
They may not get that 6 months from now.
Right.
The market may be the same or down a little bit.
Right.
But you also may have 50,000 more buyers out there that are back.
Yeah, inventory is still extremely, extremely low. Yeah. And we're thinking that, if rates, we're seeing it already, but if rates, continue to steadily trend down, we think that there could be a frenzy again.
Yep, I absolutely agree.
Yeah. For sure. So what are some other ways that you could, buy a rate down or adjustable rates?
You could do it.
Ours?
You could do an arm. You could also just pay points and have the seller pay for those too, and just buy down the rate. For example, the same cost of that 2-1 buy down, you could just buy down the rate about a point, and instead of getting 6.6, you get 5.6, and you're locked in at 5.
There's a max amount though of how much you can buy down?
Depending on how much you're putting down.
Okay.
Or you could actually look at an actual arm, like I've discussed. It's people are still scared of arms.
Yeah, arms, back in 2007, 2008, arms were like
And
no good.
I'm kind of a yes and no on that, depending on how much money you're putting down on the property. If you're putting the very bare minimum and the market does dip 5%, right when your arm's getting ready to adjust, you're in a spot where you can't refinance. You have no equity to refinance.
Okay.
If you're putting 40-50% down on the house,
Which, how many people do that?
not that many.
Not that many.
There are a number, but not that many. But if you're putting over 20%, I'm okay with an arm as well, especially like a 5 or 7 one, because you're locked in for 5 to 7 years. And in that amount of time, we're going to have probably 2 different types of economies happen in that realm of time.
Right. So you're not extremely afraid of them. It just depends on the scenario.
And just mainly because lending is not what it was back in 2008 when everyone was doing arms. Most people are doing fixed rate mortgages, and savvy investors are choosing arms again because they know they can take that lower rate and save money, knowing that they could refinance or they can get out of that rate if they needed to.
Right. So explain also, I get this question a lot, which is, do I have to put 20% down on a property? Do I have to put 10, or can I do the 3%? Or just kind of explain some of those scenarios as well.
Sure. I mean, 20% is what everyone knows
Why?
because there's
Why is
no
that
mortgage
beneficial?
insurance.
Right.
However, mortgage insurance is very credit score driven. If you have a borrower that has a 760 credit score, putting even 5% down, 3% down,
Right.
sometimes that mortgage insurance is only going to be $100 a month. Are they
which
better
isn't
off
bad.
keeping the cash in the bank if they are worried about a job or having a slush fund? They may be better off not putting the full 20%. And depending on their income, they can write off that as an interest write-off.
Gotcha. And then for those that go for like a 3% down, what type of program is that?
It's a first-time home buyer program. The mortgage insurance is a little bit more expensive on that program.
Right.
So if they can put 5%, I usually direct them towards that. They'll get a better rate and a better rate on their mortgage insurance.
Right. And then chat a little bit about VA loans. What are the benefits of VA loans?
The biggest benefit is there's no down payment required. It's probably the best loan going, especially if the veteran is receiving any disability, 10% or more, because there's no mortgage insurance, but there's what's called a funding fee on a VA loan, which can get pretty hefty. I think it can almost approach 4% of the loan balance gets financed on top of your loan.
Oh,
So it's almost like you're prepaying your mortgage insurance. You're not paying it on paper, but you are.
right.
But if you are disabled, you can do a true 100% no down payment and get a better rate than what conventional rates would be
But you can only have one VA loan at a time,
at a
correct?
time. And they're mainly set up for primary residences only, so it's not like an investor going and using it.
Right. So do you see people typically go that route if they have the option to? Yeah.
Yeah.
It's just the smart way to go.
Yeah, especially if it's their first one, because the funding fee is very low if they're not disabled, and
Yeah.
it's better off. They can save a lot of cash. Now, we always go over their budget. Sometimes veterans will put 10% down because it lowers the funding fee a little bit,
Right.
but still no mortgage insurance.
So lastly, let's just chat a little bit about, do you think that, it is wise for people to get out there and purchase where rates are right now? They're not that bad. People got
No.
scared
They're not bad.
and sticker shock, but historically they're not bad.
I look at everything as, what are your overall goals? If you're looking for, I'm going to buy and flip this property in a year, I don't know if you'll be able to do that.
Right.
If you're buying this home as a home, and you can afford the payment,
Yeah.
it's a long-term asset. And look forward 20 years from now, it's going to be worth exponentially more than what you paid for it.
Right.
And obviously, you want to compare it to what you can currently rent for. And if it's pretty equal, then I would lean towards buying.
Right. And as far as investment properties go, what do rates look like for investment properties?
Rates right now on investment property, they're pushing closer to 8%.
Are they? Wow.
They become a little bit more expensive with the current environment. But I've seen quite a few of them still cash flowing as well, if the numbers work out.
Right, yeah. You just have to make sure that the numbers work out.
They may need to put a little bit more money down than they did before to make sure that they pencil out.
Right. Thank you. Anything I didn't ask you that you wanted to add?
I don't think so. I think we touched on
Hit
a lot
on-
of the
touched on
big
all-
things that I'm getting asked is the ARMs, the
Right.
paying points, and the 2-1 buy downs.
Right. Yeah, I know people are just wanting to get those rates down, but like we said, historically, I mean, rates were at 18%, I think, at some years, like in the 80s, my parents were
I
telling
think
me.
it's over the last 30 years, we're still right around 7 is the historic average. So
Is the historic average.
So we're still below that.
Yeah. And I think personally, once we hit the 5s and stay in the 5s, I think the frenzy will start again.
Mm-hmm.
I think people will really,
And it's been, what, 8 months since the rates have really jumped up? Everyone knows about it now.
Right.
They've seen it.
Right.
They've probably calculated what the payment looks like.
right,
And we're seeing people coming back out
Yeah.
because they've determined they can buy.
right. Yeah. And actually now is obviously a great time to buy because we're not seeing the frenzy
Mm-hmm.
and you can get the seller to agree to some concessions.
Yep.
So it's a perfect time.
It's more fun on my buyer side because they can take their time a little bit better.
Right.
And they can sit and look at 4 or 5 homes and determine, I like this home.
Yep.
Two years ago, we've had people that are actually mad that they bought the
Yeah,
house. They
buyer's
bought.
remorse. Yeah.
They got a
felt
great
like
rate. They're happy with their rate, but they're not happy
Sure.
with the product.
Right. They had to just jump so quickly that they go, this isn't really what I wanted, but I was caught up in the frenzy.
Now my buyers are happy with the house they buy, not necessarily with the payment.
Yeah, right. Thank you,
Yeah,
Josh. I
I appreciate it.
appreciate it very much. And if you have any questions about everything that we went over, because I know that it was a lot, please drop a question below. You can also reach Josh. His information is listed here. You can also give me a call if you have any questions, or if you're thinking about taking advantage of this market and, getting some pretty, decent deals with concessions and as far as that goes. Also, any subjects that you would like us to cover real estate wise or investing wise, drop a question below, drop your idea below, and I will take a look at it. Thanks.